So, so you're enjoying the conference so far, yeah?
Yeah, I like it a lot. Yeah, a lot of interesting things happening. People are talking about regulations and real-world assets. So that I think is the next big move.
Yeah. So we spoke a little bit about the real-world asset total addressable market and how it seems like it's the next big thing. It is a massive unlock, and there was a talk yesterday from Robert Leshner.
Yeah. What they do at Superstate is really great. Yeah.
Yeah.
I think with their experience after Compound, definitely they can make this change happen. And through this real-world asset tokenization, it's the crypto world that will give the value to the off-chain world by providing this programmability. And this is really a huge opportunity for the both sides.
Yeah, and hopefully it can make certain assets that are kind of siloed off-chain right now. Like you don't see, like, there's real estate, but you don't see it composable with other markets. Maybe.
Yeah, that's right. There were some projects that tried to tokenize real estate in different parts of the world, for example in Dubai, but it's not yet really adopted and integrated with other on-chain solutions. So yeah, making it transferable between different chains and to allow this composability is important. Yeah? Not just tokenizing it, that's it. Yeah, tokenizing to become part of the assets freely circulated across different protocols. This is the value. Yeah.
I think that's an important point. Like, we talk about tokenization of real-world assets, but it doesn't end there. There's so much more that happens with the tokens after tokenization.
That's right, yeah. Maybe some adjustments will be needed to allow RWA freely transition across different protocols, something like KYC and other limiting approaches, but it should not be fully permissioned. I mean, we should never go to direction of completely permission chains. It's not the right path, but maybe creating some KYC and verification mechanisms in public ledgers that will be required by the regulations for WA is definitely the way to do it. And what's happening now in chains in layer 2s created by big enterprises like what Coinbase is doing with their base and also Linear, I think these ledgers will really adopt the RWA move the next run.
I think so too. They have the relationships with some of the off-chain partners and banking partners that are currently custodying some of these real-world assets. So they're in a great position to put those assets on-chain. So let's talk a little bit more about Primex.
Yeah, let's do.
Yeah.
So actually, I'm Vlad, the tech co-founder of Primex Finance. It's a prime brokerage protocol that allows us using borrowed liquidity from lenders for different specific use cases without over-collateralizing this liquidity, because it never goes directly to the wallet of the borrowing party. Instead, it's used for specific use cases. And the first one that we implemented is for spot margin trading. This means that the other role in our protocol is a trader who can borrow these funds and open spot margin positions using existing DEXs. So we're integrated with multiple DEXs. We wrote a trade to these DEXs, Uniswap and some others. So actually we have a DEX aggregator as part of the protocol, but it's not the core thing. And the trader is paying a fee for using this liquidity. The lender is earning, just like in a lending protocol. So for a lender, you can say that it's a lending protocol without an impermanent loss risk like a liquidity provider in some other protocols, because the funds that a lender puts into the protocol is exactly what they can get back without a risk of transfer between several funds in a bucket. Yeah.
Okay.
So for a trader, we have now quite an advanced user interface. We can say that it's a trade terminal with different capabilities, very similar to normal centralized exchange, with different order types, with the settings of stop loss, take profit, and of course with the leverage parameters.
Right.
Yeah. And
With cross margin that enables leverage.
currently it's not the cross, but the isolated margin.
Okay.
Yeah,
I see.
we are considering to introduce cross margin a bit later. Currently, it's isolated margin, so this
Okay.
means that the trader can bring their asset. We support different combinations. I mean, they can bring, for example, I don't know, wrapped BTC. And then borrow USDC, yeah, and then buy Ethereum. So open a long position on Ethereum using this.
Okay.
But
Okay.
the collateral that the trader brings is also changed to the asset of the position. So in the most simple example, can say that the trader can bring, let's say, 1,000 USDC on their own, borrow 4,000 USDC from the protocol. It's a 5x leverage, and then buy, let's say, Ethereum for this 5,000. It's a 5x spot margin position.
Okay.
And after that, it's actually the ETH that was purchased that is protecting the borrowed funds. Yeah, because it's locked in the contract. The trader cannot steal in any way these funds. The only thing that we can do, the trader can do with this position, is closing it with a profit or loss manually. Or a position can be closed automatically by stop loss to take profit settings, or it could be liquidated. But all this happens thanks to one more role in the protocol, a keeper, that are responsible for trade execution. Trade execution is also decentralized, so we don't have any backend responsible for doing this. It's this keeper role and an app at the same time that can be launched on any desktop machine. We do also provide it. So the keeper is incentivized because on each action like this, they get a small profit. So they get compensated for the gas fee plus some profit on top. That's it. So there are three main roles: lender, trader, and keeper. We have a lot more other improvements to introduce into the protocol, and maybe one of the most important is more like composability, because currently it's just one use case for trading, but these borrowed funds could be potentially used for a lot of other things, like, for example, LPing into Uniswap Web3 or in any other protocol that can potentially generate some interest for this user. And if this interest is higher than the fee that they have to pay in Primex as a borrower, then it's a potentially profitable
arbitrage opportunity.
Yeah, that's right. Yeah. And it's up to the user to use this in their trading or market making strategy. We just provide them the instrument.
Got it. Okay, I think the most curious question that our audience would have, because leverage is something that really under-collateralized leverage is something that has kind of escaped the industry for a long time. If you look at MakerDAO or some of these other protocols, all of these systems remain solvent through over-collateralization. And then when a particular account becomes under-collateralized, then we have a network of liquidators that will liquidate those positions, and then the under-collateralized position is erased. So I think you did touch on the mechanism between keepers and traders that allows for the under-collateralization. Maybe you can specifically talk about how the protocol remains solvent, even in the case of under-collateralized positions.
Great question, thank you. So it's quite straightforward. Of course, we do have this liquidation mechanism as in any protocol that has any type of risks. But based on a specific pair, we have different settings for the moment when we start liquidating. So it's the smart contract that validates this action from a keeper who tries to liquidate position if this really should happen. Basically, it's like a health factor in many other protocols that calculates how much of the collateral in a position is still present and if it's enough to buy back the borrowed asset. So in my previous example, it's quite simple. The ETH that was bought, in a simplified way, we can say that as soon as we have just that enough of ETH to buy back 4,000, then of course we have to liquidate this position because it's the amount that was borrowed. So we never really go, at least in the current implementation, we never go below the undercollateralized use case. Just the collateral is the asset that was actually bought and now present in the position. And the same with other use cases. If we consider, for example, Uniswap 3, as a place where the borrowed funds were moved, it's the same thing, just the health factor has to be calculated differently. And when we see that the borrowed funds are at risk, we just revert this action. So we take back the funds from Uniswap 3 to put them back
into the collateral,
into the bucket, the bucket from where it was taken. Yeah.
Okay.
So the difference is that this mechanism of liquidation is fully decentralized and remains secure thanks to the how keepers are incentivized. Actually, very similar to what we have in MakerDAO. Yeah, it's the same approach, and the difference is from some existing non-custodian but still centralized margin trading solutions that have their liquidation engine in a centralized manner.
Okay.
Yeah.
So in Primex, I can bring 1,000 USDC and then borrow 4,000 USDC. For example, I can use that 4,000 to buy ETH, and then the
𝗶𝗵. Actually, 𝗶𝗵 can be used to buy ETH. This improves a bit the capital inefficiency because if we keep the collateral unchanged, this reduces the potential of buying, the buying power.
Yeah. But I cannot withdraw 4,000 USDC.
Never.
Right.
That's the difference. So it's the difference from the lending protocols. That's the reason why these 4,000 are borrowed. You never have to bring a collateral in a different asset, and with over-collateralization, at least, I don't know, 150%. So of course, this makes a lending protocol unreasonable to use borrowed funds to open any margin positions. There are other great use cases for a lending protocol, but not for trading. Yeah.
Okay, that makes sense.
For a trader, we can say that the value that we bring is it's actually DEX, but with a lot of these additional capabilities, usually unavailable in a classic DEX.
Yeah. And I heard Kane from Synthetics give a talk about a combination, almost like a hybrid model between centralized finance and decentralized finance. And he actually that was his preface. That was how he introduced the new product that they're launching. And the model at Primex sounds like a similar hybrid model because you have the decentralized functionality of a decentralized liquidator mechanism, and you are on-chain, which uses decentralized settlement. But there is a form of, I don't want to, what is the right term? Because it's not centralized, it's not custodial, but not
Yeah, it's
able to withdraw.
decentralized and non-custodian. Actually, it's some kind of new DeFi primitive that we are going to extend to other use cases, not just trading.
Okay.
So the idea is allowing using borrowed liquidity for specific scenarios. And we can abstract this use case in a way that, let's say, there is something in between the borrowing step and the final, let's say, collateral that returns to the smart contract. And it could be like a black box in between. In the next versions, we're going to implement this approach as well. So we cannot even care what happens in between, something like in a flash loan, but it's persistent. It doesn't end in one transaction. Yeah. And if in the end of this chain of steps, there is something that returns into the protocol, into the smart contract, that is enough to collateralize the original borrowed amount, then we can accept such a, let's say, position, yeah, and allow it.
Okay.
And this way we can even allow other users, other even protocols, to integrate with us when we implement this feature, so they can actually put between these two steps something that will be potentially profitable in their protocol, and we won't even care. So yeah, something like a smart contract in between.
I like the mental model of a procedure of transactions, where as long as you have the origination and the end destination, as long as those two transactions are met in sequence, you can allow this very like fertile, very like creative middle ground.
Exactly, yeah. It's all happening in one transaction, but yeah, in multiple, let's say, smart contract calls, and or some other smart contracts could be introduced in between. Yeah, the only thing that we care is what we get as the final step is enough for us to collateralize the debt. Yeah. I'd like maybe to briefly also describe what we did related to security. Of course, we had audits, not just smart contract audits, but more integral review of the whole infrastructure, including front end and also the settings, the final settings that we put in the contracts when we deploy them, because it's a very important thing. Auditing just the code isn't enough to make users secure, because usually the difference is in the actual values. And we asked two of our auditors to do this final review of the settings when we really deploy. We're going to deploy in October, finally, first in Polygon and then to Arbitrum and some other EVM chains after that. So this review of settings will validate that everything is finally correct, because the code depends on the values, of course.
Right, okay.
What else? So we had audits with QuantStamp, Alborn, and Resonance. They're all great, but maybe I'd like to add some words about Resonance. They're quite new, but we liked a lot the approach. They try to see not just one thing, not just smart contracts, but also the whole picture. And they audit front end, different backend infrastructure, if it's present in the protocol, cloud infrastructure, everything. And they do it really in a very detailed view. What else about security? We are using Hypernative to monitor some critical state changes in the contracts. Very important thing. We like them.
One question I do have, I think because it is a unique solution, some people might be wondering, like, how do you enforce the return of debt? Because if I borrow some margin, even if I keep it within the protocol, there has to be some mechanism that returns the debt to the lender.
Yeah, definitely. So actually, this works in a way very similar to a lending protocol. While this debt is active, a position is active, of course, the borrowing party, the trader, has to pay for this.
A funding rate.
Yeah.
Okay.
It's of course in perps, in derivative margin trading protocols, it's usually called the funding rate. In our case, it's a bit different because it can never be like negative. It's always positive. The trader is paying for the borrowed funds because they're locked in this position.
Yeah.
So this is actually a difference. And if we imagine even such a situation that the price of a pair never changes at all, like
They're still paying funding.
They're still paying.
Okay.
And at some point, the collateral that is present in this position will end because it's calculated to compensate the fee.
Okay.
And the position will be liquidated, but of course it will take years because of course this funding rate is quite small. Yeah.
Makes
That's
sense.
it.
Okay.
Yeah.
So the collateral that the user deposits pays the funding rate, and then and then they can retain the debt as long as they like, as long as they have some collateral.
Yeah, and there are also different possibilities to change the position, including deleveraging it, so adding some collateral. Like in a normal exchange, there are different parameters that can be changed in an existing position.
Awesome. Okay, that makes sense. And then once that collateral runs out, that's when the position is liquidated.
Yeah.
Okay. And do they ever have, like, is there a maximum amount of credit that I can take from the exchange?
It of course depends on the size of this shared pools that we call buckets.
Okay.
We're going to have multiple buckets, and they will differentiate not only on the asset type, but also on different settings that are related to risk. So, for example, we could have even two buckets of the same asset, let's say USDC, but in one, this USDC is allowed to be borrowed for trading more stable pairs, like ETH or BTC, and another bucket for like more volatile, higher risk assets. Yeah, and these two buckets will have different amounts of liquidity, of course, and different leverage settings, and different utilization ratio. Yeah. So the idea is to give to both lenders and traders this flexibility, so the lender can select from multiple or create some kind of portfolio with different buckets, each with different interest rates. But of course, those that will have high interest rates are potentially like more risky, of course.
Yeah.
Yeah, because if the protocol works correctly, we never have a loss because the position is liquidated in time. But of course, there is some small probability that something really huge happens with a specific pair and it drops to zero just immediately. Yeah, of course, it may happen that for this pair, these positions, the keepers won't be able to liquidate them correctly.
So you have to be very careful with the pairs.
Exactly, yeah. But initially we're launching with the most stable assets, and we are going to introduce more risky assets later in separate buckets.
Okay.
Yeah. That's it. Yeah.
And you guys have a liquidity mining program coming up.
Yeah. Speaking about the launch, we have two approaches. First of all, we already have the referral program. It's quite active in the testnets that we have. The protocol is running in testnet for some time already. The users that come now, their relationship, the connection between those who refer, those who are invited, is already recorded, and it's recorded on chain, so we cannot manipulate it in any way. And later, the real activity when we launch the mainnet of the users, different type of activities. Yeah, if it's a lender, how much they lend. If it's a trader, what type of positions they open and how long. All this will be, of course, calculated to incentivize and compensate those who invited them. This is the referral program.
Yep.
And the other early user programs, they include this liquidity mining thing. It's quite important because we need to have liquidity in the markets to launch this margin capability. So specifically, while the market isn't yet active and the funds are not borrowed to generate like normal interest, during this time, the early lender, the early liquidity provider, has to be compensated for this period, and we compensate in our early tokens that later will be transferable to normal tokens. This compensation definitely will cover some kind of, loss that they didn't use these funds to put in a, lending product. Yeah? So at least this, but definitely much more to incentivize them.
Yeah. So early stage liquidity providers are rewarded with tokens that will offset any type of interest or earnings that they could have gotten from some other liquidity pool.
And of course, as soon as the bucket is launched, it's the normal interest that becomes active as soon as the borrowing capability is allowed. Yeah.
Is there
for the traders as well? We have an early user program that incentivizes them to use the protocol to open not just margin but even spot like 1x positions, and we'll calculate the activity of the traders as well to after that reward them.
To reward them as well. Okay. As we kind of, I have one question as far as the liquidity mining program. Is there a amount of liquidity that you will, once, like a critical mass of liquidity that once you exceed, that's when you will open up the new markets?
Yeah. This is working exactly like this. I don't remember the real numbers for now because they're different for different buckets, but it's based on the popularity of a specific asset in a specific chain, and we are using information from existing DEXs, from lending protocols for a specific asset and a pair, and based on this we set this minimal amount for each bucket to actually allow the borrowing capability, because in a critical situation, if for example we launch a bucket from zero, it will be very unstable. The utilization ratio will jump back and forth all the time, so of course we need some first amount to launch.
Awesome. I think it's going to be a big community push to reach that critical mass. And it makes sense because you're rewarding the early liquidity providers. So in theory, the liquidity providers rush into the pool to earn the early rewards, and then after it hits the certain level, then it will unlock the funding rate from the market.
We also try to protect a bit from those who just try to chase this first rewards and then disappear. So we have some small period of so-called like stabilization while the borrowing capability is already allowed, and the lenders start earning normal interest rate, additionally to their early user rewards. But during this stabilization period, they still cannot withdraw their original funds without losing their reward. So if they withdraw, they will lose this reward. But it won't be really long, because it's needed just to make traders start using the market.
Yeah.
I'd like also to address our existing community. Thank you. They're really active currently on the testnet and in the Telegram and Discord groups. I think maybe someone is already a bit disappointed because unfortunately we developed this a bit longer than expected. So yeah, we're finally launching in October, first in Polygon, then in Arbitrum, and other EVM chains planned, including Ethereum mainnet. There are some limitations related to the fee that a keeper has to pay for the gas fee that they have to pay. So in Ethereum mainnet, the minimal position size will be a bit adjusted. It will be a bit higher than in cheaper layer 2s, but it's still doable. We have the values and it looks quite reasonable.
Awesome. I think this has been great. That's about all the questions I have. If there's anything else that you'd like to add or tell the audience what they can do to get more involved and participate, yeah, this has been a lot of fun. So any closing thoughts?
Thank you. Yeah, stay tuned. We have different more capabilities planned on the roadmap, not just for trading, to do different DeFi composable yield farming things with the borrowed funds. We'll deploy on other chains. We also plan to introduce cross-chain rebalancing between these buckets that will improve a lot. We try to make the user interface quite simple for all normal people. Really, I believe that it's an important thing to make the adoption happen. A protocol should not be overcomplicated for a user. It can be very difficult in the internals, but it should be very simple for the user. So for this, we are also planning to integrate an on-ramp thing to make people easily top up with fiat. Yeah, so yeah, I really believe that we need to make DeFi simple for normal people.
Yeah, onboarding, on-ramps, and even account abstraction is massive
exactly.
for the onboarding
We are
experience.
expecting to make some of this account abstraction standards more stable, and we'll make this integration upgrade to make it more flexible and secure for the users, because a simple wallet that everyone is using today is quite scary. I see that a lot of quite crypto-friendly people still use centralized exchanges just to store their crypto, because DeFi storage is overcomplicated for them. So we need to make this change.
Yeah, agreed. Awesome. Well, it was great to meet, and this was a very fun conversation.
Thank you.